Well. Lots of volatility has hit the markets, and we're here to cover it on the Trade-Off Show. We're going to be going through all these setups and all these developments that are unfolding in front of our eyes, and hopefully your trading screens at home. We have 1 week left without Westy, but don't worry, Michael Brown's here, and we're going to cover all of these topics that you see here on the screen. But if you love these shows and you think they're great in setting you up and giving you good trade ideas throughout the course of the week, make sure you give us a big thumbs up and subscribe to the channel so you don't miss any of this exclusive content right here on the Trade-Off. Well, traders, welcome back. My name is Blake Morrow, and like I said, we have 1 week left without Mr. Weston, but he's going to be here next week, so we're all super excited to have him back. But in the meantime, we brought back the one and only Michael Brown from the UK Trade-Off Show. Michael, how are you? Good to see you today.
Hello, mate. I'm very well. Good to be back. I'm a little bit worried about how excited you are that you're going to be able to get rid of me next week and get your old mate Westy back. I mean, I thought I had a special place in your heart after last week's performance, but, clearly not, mate.
I can't wait. So you notice I didn't wear a tie. Next week, I'm not even going to have a jacket. The next week, I'm going to be wearing a t-shirt. So, I'm dressing down for the inevitable. No, it's been a lot of fun, Michael. I've over the years, I want to say years now, I've really enjoyed our time together, talking about the markets and breaking everything down. So I am going to miss you, but I know you're not going to miss these late nights filming these shows.
No, absolutely not. But as you say, it's been good fun. And I think there must be a correlation between us doing things together and market volatility going through the roof, because to say it's been a bit of a roller coaster ride, particularly in equities and particularly in rates over the last 5 days or so, is probably an understatement at this point.
It has been crazy. We've seen, as you pointed out, you've seen rates move. You've seen the equity markets. I don't want to say implode, but boy, we've had some pretty decent moves. And the dollar complementary to all of these moves. And gosh, let's just break it all down and let's get into topical thunder. What say you?
Absolutely, let's go.
Well, let's start with the first topic of rates, since we're going to go there anyway, Michael. And this is an interesting topic, I think, because if you look at most central banks, at least the G10 central banks and most central banks even following that, we're probably really close to our terminal rate, give or take a quarter basis point up or down. You start talking LATAM currencies, maybe a little bit more aggressive, but we're pretty close to where central banks think they need to be, at least in the near term. Mm-hmm. So, for me, it's now starting to look at the divergences in where these central banks and where expectations of not only, traders like ourselves, but also economists and listening to the words of all these central bank speakers and figuring out exactly where rates are going to be going next. But data, as far as data goes, it's like, do we still look at inflation data, or is it going to be more important to look at growth data? Are we going to be looking at employment data? And does it vary based on different, regions of the world that we're looking at? And I'm going to pose that question to you. Like, what are you focused on? But first, I'll just say that, something that I've learned over the years, and about 20 years in the spot market is growth really starts with employment. And I think the employment picture is obviously going to be really critical in the US moving forward, because that's going to feed into inflation. It's going to feed into sentiment. It's going to feed into consumer spending. So that's kind of where I'm starting, is I'm going to, keep a very close eye on the US jobs report, but also around the globe as well. But how about you? Where is your focus going to be moving forward?
No, I absolutely agree. I mean, I actually spoke about this with Ryan Littlestone, your mate and mine, on the Trade-Off UK this week, and we were talking about the labour market, particularly in the US, because we've all been waiting, 18 months now, and saying, it's got to roll over at some point. It's got to start loosening at some point. And it just keeps going and going and going. I mean, job creation at 200,000 a month, jobless claims at 200,000 a week. It's just solid print after solid print. So I think the two things I'm looking very, very closely at are firstly inflation, not headline inflation, but core inflation. Do we see that continuing to come down? Because I think going from 5 to 3% is going to be a lot quicker than going from 3 to 2% on those core inflation measures. And that's what central banks are watching. So it's what you and I need to watch and what traders need to watch as well. And the other thing is growth. I mean, Chair Powell said very, very clearly last week, and other Fed policymakers have said so in the intervening period, they need to see below trend growth in order to bring inflation back to target. And until they start to see that coming through, GDP starting to slow, the pace of the economic expansion starting to roll over, then policy is going to have to remain restrictive. So I think the question now is not, do we go any higher? I don't think we do. Maybe the Fed give us one more, 25 bips or not, as you say, doesn't really matter. The question is, how long do we stay here? And that's why you've seen this real sell-off in the long end of the Treasury curve and the long end of curves here in Europe as well, because markets are pricing in the longer bit of that higher for longer guidance. And that's what ultimately has roiled the equity space over the last week, as well as that message has finally sunk in.
It's a topic that we could actually spend a lot longer than just 3 or 5 minutes talking about, especially when you talk about labor and you talk about rates and where we're going. I do want to just give since I am boots on the ground here in one of the major metropolitan areas here in the United States, I'm just going to give you some personal experience. People that I know, the younger working crowd that's more of a professional working crowd, those jobs aren't readily available. And if they are, they're very hard to get. But you take like my kids that are teenagers and working, they can get a job, whether it's at Chipotle or McDonald's or Chick-fil-A or any of these fast food restaurants. They can go around and get any job that they want. So it's really the quality of jobs, nuts, and those are the ones that we need to be watching moving forward. But anyway, I know we need to move along. So like I said, it's a great topic and something that I think every trader needs to be focused on. All right, what's next?
Absolutely. Oh, what's next? Pantomime season is what's next, Blake. I'm loath to talk about it, but I have to bring up US politics on the show this week, because we seem to be about to go through the whole charade of shutting down the government once again. The lawmakers on Capitol Hill have got until this weekend. I think the deadline is midnight Eastern time on Saturday to get a funding deal cobbled together to try and keep the government open. At this point in time, it doesn't really look like they're going to get that done. It does appear that we're going to have some sort of shutdown, however brief that may be. Now, I think the important thing here is not the question of does this get resolved and does the government reopen, because we've seen this movie hundreds of times before. We all know it gets resolved eventually and the market will probably look through it. I think the bigger questions are, firstly, what does it do to growth? Because for every week that the government is shut down, obviously the government is not spending and the employees of the government are not getting paid. So you'll probably see a drag of between 1 and 0.2% off GDP for every week that the shutdown goes on. And when you add to that the strikes that are going on, both in terms of Hollywood and also the auto workers, and throw into the mix the student debt repayments that are coming back as well, you're looking at Q4 GDP being pretty soggy, I would imagine. And the other thing, and this is what I want to get your thoughts on, Blake, we were just talking about economic data. Well, if the government shuts down, all of the stats agencies have no funding. So the jobs report on the 6th of October, the CPI number on the 12th of October, that may not happen. We may not get that data, and that would leave markets flying blind, and more importantly, the Fed flying blind into the November policy decision. So what do you think that all means? I would imagine that that's the final nail in the coffin for the idea of a November hike if we've got no data by then.
So I'm going to ask Alex if we can have. Alex, that would be a joke for a game show. Alex, I'd like more than 5 minutes, please, to talk about this subject. Anyway, no one else has got that joke, but it's okay. We're all going to laugh internally and pretend it's funny. But the topic that we're going to talk about, the U.S. government shutdown, is actually not funny. And actually, what you're discussing is really important, because it really is going to come down to, is there going to be some sort of stopgap funding bill that's going to be passed that both sides can agree to while they cobble together some sort of, you know, budget agreement moving forward, because nothing that you're exactly right. Nothing looks like it is going to pass the way it looks right now. And I haven't focused a lot today on the government shutdown, because I've kind of faced the music that it is going to happen. What's going to be the market outcome, which we're obviously going to be talking about a lot of setups, but more importantly is if they can pass a funding bill to at least, you know, get us some of the services that we as market participants are going to need from the BLS, you know. And you're right. It's like, okay, so were there good jobs report, and are we going to have to just be really backward looking in a month or two, which could very realistically happen. The question is going to be for us, Michael, is what's the response going to be in the markets? And I think that's where the trade setups that we talk about today are really going to come into play. So really big topic. And you're right. We're a couple of days away to, you know, the world ending. Just kidding. It's not.
That's what folk on Twitter would have you believe. But the world's not going to end. The dollar's not going to die. It's just a bit of political to and fro.
It is. It's a lot of political hubbub, but it could, as you succinctly put, could leave us a little blind moving forward. So let's talk about like the next topic. And yeah, you gave me a little bit of a hard time pre-recording this show about this.
I was hoping you weren't going to mention that.
Well, here's the thing, Michael, and this is where traders really, as you know, this is obviously a trading show, as the trade-off is both the UK and the Australian version. You know, you get to a point where markets have moved, where you have to take a step back and say, okay, do I join this move, this direction that we've been trading? Do I have good risk reward? And, you know, for me, it's always that question of, is the market strong enough for me to fade? Because if I feel that it's kind of been a weak move, I'll trade both sides of the market, which I'm very well known for doing, and so is most traders that we know. But the flip side is, if the trend is too strong, but it's overbought or oversold, in this case, if you're talking about equities, they might be oversold. Do you keep selling, or do you wait for some sort of tactical bounce to get short? And then, and if you do wait for that, is the trade ever going to come? So these are the really tough questions that we all are asked as traders. Hopefully you found yourself on the right side of the move over the course of the last couple of weeks, and hopefully we've played a part in that as a show here at the Trade-Off. But at the same time, now we are where we're at. Do you trade with the trend, or you start trading counter trend? How do you come to those conclusions, Michael?
Well, no, it is a very, very good point, and it is a very wide-ranging topic. I mean, I think this is an opportune time to be discussing it, because you think, you know, the S&P has come down, 6% over the last quarter. The dollar has rallied for 11 weeks in a row, and the pace of the sell-off in treasuries as well has just been, quite frankly, relentless. I actually said at the start of the week, I said this to Ryan, and I also said this to some clients internally, that, you know, we were looking at the S&P 500. I think we were trading just shy of 4,400 at the time. And I was saying, I don't want to do anything. I don't want to chase this lower. In hindsight, that did turn out to be the wrong perspective. But as you say, the risk reward was, in my view, I'm looking to be long. I'm looking to take on risk, but this isn't a level where I'd want to do it. If we get above 4,400 or we test 4,200, then I may do so. But right now, I'm happy to sit on the sidelines, wait and see what pans out. And I think this is where discipline is really important for traders of all experience levels. It's having your core thesis and idea around where you think the assets you trade are going to go. If you trade through a technical lens, having the levels marked up on your chart that you're looking for price to get to, and see how we react there. And then waiting for us to get there. Don't go chasing things, and don't go looking for moves that perhaps don't exist. We are seeing volatility pick up across the board. I mean, the VIX is currently at 18. Earlier in the week, we were at our highest since mid-August. On a closing basis, the highest since May. So we are starting to see some of these big moves take shape. The key is protecting your capital so that when the moves do take place, you're able to take advantage of them, and you can actually get into the market at an opportune time, and not trying to chase things and force things when perhaps they're not really there.
I think you bring up so many great points that I'm glad that you brought them all up. And the other thing that I also think about is the sizing. If you're unsure, there's two things you can do when you're unsure. Take down your position sizing to where it's small, where you can have a wider stop loss so you can sustain some volatility. And then also, no trade is also a good trade sometimes. So yeah,
absolutely.
Cash is a position, as you might have heard. All right. Well, that was my topic that I thought we should discuss, especially after having, and that 6% move in the S&P, most of it came over the last 3 weeks, which is wow,
and it's still coming.
It's still coming. Yeah. All right. I know we need to move along. So
right, I want to look at some of next week's central bank decisions. The RBA and the RBNZ both due up. The RBA on Tuesday and the RBNZ on Wednesday, both horrifically early in the morning here in the UK. I think the message from both is going to be pretty much the same as the rest of the G10 central banks, focusing on how long they spend at their current levels, with terminal now having been reached, rather than whether they're going to hike any more. The market does price about a 1 in 3 chance that the RBA go again in the November meeting after a hotter than expected inflation print for August. But with most of that being driven by energy, I don't really see much of a chance that they tighten policy significantly further. Again, I think as we discussed earlier, the focus now is shifting to the duration of time they spend at terminal, and then by extension, who loosens policy first, who delivers the first cut. And to this end, I must give a little bit of a tip of the hat to Adam Linton over at News Squawk, who raised the very good point that the RBNZ were the first to end their tightening cycle back in April, 6 or 7 months ago now. So very, very quickly, they could have spent 12 months in restrictive territory and perhaps even be looking to loosen rates, and the first G10 central bank to do so. So, Blake, you asked me a difficult question earlier on. I'm going to ask you a difficult one now. Which central bank do you think is going to be the first to cut rates? And for a bonus point, when do you think they're going to do it?
Well, they're going to do it March of 2024. I mean, of course, that's exactly the date I was thinking in my head. That's a great question, and the answer is I don't know. And the reason why I'm going to say is big variable is going to be China. We've both, obviously, Australia and New Zealand, huge trading partners with China, and China's done a lot of stimulation, taken a lot of measures, but in small quantities, but massive amounts of it. And I think that's one of the things that are keeping the Aussie and the Kiwi dollar against the dollar so steady where they're at and where they've been for the last, let's just call it month, is I think everybody's trying to see if these measures are going to actually kick in and help the Chinese economy, therefore trickle over to the Australian and New Zealand economy. So, I wish I had an answer, because I obviously don't. But the great news is the technicals show really tight consolidations, both in the Australian dollar and the Kiwi dollar, meaning both of those against the US dollar. But more importantly, you're going to be able to see them matched up one against the other here shortly, as we're going to talk about that in one of the setups. So make sure you guys and gals all stick around for that. But Michael, that poses a really good question. News Squawk, the gentleman at News Squawk, said about New Zealand. Is it really a measure of how long a central bank stays at what you could consider their new neutral or a new terminal rate? And is that really an appropriate measurement? How long that they keep their stance tight? And I think it's to be seen, but I'm not sure that is what I'm going to be looking at as far as like, it's been 12 months since they've raised or started raising rates, since they stopped raising rates. So they're due. They're there to cut.
No. I agree. You certainly can't be using time on its own, but I think the thing to remember is the more time that's elapsed, the more time tightening has had to sink into the economy, the more of those lagged effects have taken place. And on a relative basis, those lagged effects are coming through earlier in New Zealand, for example, than you might expect to see in the UK or in the States.
That is a very, very good point. So maybe the measure should be from when the central bank started raising rates versus where they stopped raising rates, because the staying at neutral for a central bank is a de facto tightening, especially if they're letting some of the balance sheet roll off too. So, it's going to be tricky. And I'm going to say this before we move along to the setups that really have our attention here, is that I think economic books that you learn from and the ones that I've studied from over the years are going to be changing after what's happened over the last 5 years or so.
Absolutely.
Maybe 13 years, right? Everything is getting rewritten right now.
100%. Should we get into some charts?
Let's do it. Let's jump into that's a setup. Shoot, I almost forgot what my first setup was here, and I forget that I have to be the first one to do this, and I'm not going to get used to it, which is good news because Westy will be back this next week. So, my first setup is going to be gold, and you and I had a little bit of an exchange, but I think that was great fodder for a conversation that we could have right now about gold. And I just want to throw out there, first of all, gold technically is in this descending wedge. You can see that red trend line that we've respected it for quite some time now. And if you're not new to this show, you've seen this chart before because we've discussed it. I also blogged about it a couple of weeks ago, looking for a turn lower into new trend lows. And we just, pierced that today at 1895 or 1885, excuse me. But the trend line comes just below it. We got a couple fib levels below that. Basically, what I'm trying to say is there's a lot of support down here. And it's questionable whether you want to, go long and take it for a long trade because you know that your risk is fairly manageable. Flip side is if it does break below, that 78% retracement, you could probably see some accelerated selling. But this is where I wanted to get your take, Michael, because one of the things that I've been discussing is if we do have a government shutdown, the dollar may gain strength, but also I think assets like gold could also gain strength just as a risk aversion type of hedge, if you will. So what are your thoughts on gold here? Because the rates market, obviously, is it the tail wagging the dog or the dog wagging the tail? I'm not sure.
Yeah, it's an interesting one, actually, gold. I mean, it seemed today, Wednesday, to finally wake up to the fact that the dollar's just been charging higher and that treasuries have been selling off relentlessly across the curve for a week and go, oh, maybe we shouldn't be trading above $1,900 an ounce. Bearing in mind those factors, nominal yield screaming higher, real yield screaming higher, the dollar screaming higher, I really cannot see much going for gold at this point, in all honesty. If you want a haven, then why not buy the dollar? And why not, if you even want to go into bonds, why not buy 2-year treasuries with a 5.5% yield? That would be, to me, much, much more attractive. I think for a more medium-term view, at the very least, I think the opportunity cost of holding gold is just far too high at this point. But maybe if we get back above $1,900 an ounce, that equation changes a little bit. But I think if you're after safety, there's better harbors to seek that in at the moment.
All right. And one thing that I'm looking at, guys and gals, the breakdown below 1885, that was a big deal today. But if we can get back above that, especially back above 1900, then you get a false breakdown and a reversal. So that's something that I'm actually queued up on looking at on this setup. So what do you got for your first setup, Michael?
What I have, Blake, is something a bit different and something that may make people scream given how ugly the chart looks, but I promise you it makes sense. So I'm looking at the yen first of all, and the reason why I'm looking at the yen is because it seems like every man and his dog, or maybe every person and their dog these days, is sitting here waiting for the Japanese authorities to step in and intervene to try and prop up the value of the yen. Everyone on the sell side has been screaming about 150 for weeks in dollar yen, and well, at the time of recording, I think we're about 50 pips away from that. The truth of the matter is no one really knows what the Japanese authorities are watching when they come to the decision of, do we intervene or do we not intervene? Are they looking at spot yen against the dollar, the euro, the Chinese yuan? Are they looking at a trade weighted index of the yen? Are they looking at volatility, or are they looking at a mix of all of them? And that's why I've put together this range of indicators. So what we've got here is dollar yen, euro yen, yen against the CNH, sorry. And then the bottom two gauges are the most important, because what we're looking at there is 1 week and 1 month implied Japanese yen volatility. And this is really, really key, because if you look at what the Ministry of Finance have done previously, and when they've stepped into the market previously, it's not been because we've breached a certain psychological big figure. It's been because we've seen volatility go through the roof, and they've been able to describe that as a disorderly market. If you look at what's going on now, dollar yen above its prior intervention levels, same with the euro, same with the Chinese yuan. 1 week and 1 month volatility have not really budged anywhere off the lows. And I think that is probably what's keeping the authorities on the sidelines. So for now, given that yields are moving higher, given how bullish I am on the dollar, and given that the BOJ seem as far from ever from tightening things up, unless we see a big pickup in volatility, I'm happy to remain long the yen, and that big pickup in vol will be my warning sign that actually intervention could be close, and that's the time to close out yen shorts. So keen to get your views on the yen and on what that big mix of charts may present to you, Blake.
Well, I'll just make it simple. If the dollar yen sees 155 overnight and then back down to 150, that means vol spikes. That means we buy yen. There we go.
There we go.
Case closed. No, actually, one of my colleagues, and actually Ryan Littlestone's colleague as well, from the Forex Analytics side, he brought up a great point today, just because we were talking about end of month flows, and they're all the banks are reporting dominant U.S. dollar buying coming in. A lot of those flows fixings are getting done right now midweek. But if you're the Bank of Japan and you're very well aware of this, and you know that the dollar yen is going to probably surpass 150. Do you wait until you get past the end of the week, end of the month, if you were just on the verge of intervening, which is a great question. So I think, there's a lot surrounding this 150 level, but I don't think 150 is, I've been planning on selling there for a long time up at these levels, like for the last several weeks. I took myself a little bit of it today, but I also am very well aware that it can go a lot higher than where it currently is. So you got to trade position size accordingly in a situation like this. And I agree with you. 150 on the dollar yen is just a number, and volatility is probably where you should be cued in on right now. So
absolutely one to watch very, very closely, I think. Great
point. Well, the next setup I wanted to bring was the Aussie New Zealand. Now this came from Casey Trader, and thank you very much. And by the way, I need to say, Casey, thanks for writing in your question, and he wanted to see more of the Aussie and the New Zealand. So we thought we'd just lump them together and give you the Aussie Kiwi. So, but I just want to throw this out there for those of you that want to see a specific instrument. Make sure you jump in those comments down below. Let us know what you want to see, and we're going to try to get to it. Westy, he's really, really big on this, so make sure you jump down there right now after this analysis. Actually, after Mike's analysis. Actually, after you're done watching the whole video. So
eventually leave a comment.
Yeah, and you have to leave a comment too. All right, so the Aussie Kiwi, you'll notice there's a 618 retracement that comes in right around horizontal support, right above 107. So this 107 level, I think, is going to be a really big do we or don't we, above or below. It makes for a really nice neutral zone. So if you want to be on the long side, as long as we trade and close above 107, I think you can pivot, to a long Aussie, short Kiwi bias. We start breaking below that, then you have to be laser focused on around the 106 level. That's a multi-year trend line that comes in from the post-COVID lockdown lows. That goes all the way through all those lows. That's where really critical support comes down. So if it does break through 107, you want to take it for a nice little ride back down to 106. I think that's a good setup for a short. So that's what I think about the Aussie Kiwi. You have any comments here, Michael, on this pair in particular?
Yeah, it's an interesting one. I mean, I actually like this higher over the medium term, to be honest. Going back to the point we were making, I think the difficult thing with the Aussie Kiwi is to liken it to something close to home. It's a little bit like Euro Sterling. You're dealing with two very, very similar economies, two very, very similar policy stances from central banks. And when you're then trying to trade that in the FX world, there's not that much of a divergence to exploit. But occasionally there is, and that's when you see a really big move. So as with Euro Sterling, Aussie Kiwi can just go sideways for a very, very long period of time. and then all of a sudden we move in one way or another. And I think that might be what we're in danger of seeing here. I think we could get, a month or two of consolidation, but then over the more medium term, I think the Aussie should outperform against the Kiwi, because I think there's more of a chance that the RBA, one, tighten further, and two, maintain rates at their current level for longer than we see from the RBNZ. So for me, I'd be sitting on the sidelines for now, but I do like this higher over the slightly longer run.
Awesome. Thank you for those comments.
Always a pleasure, Blake. I've also chosen a chart from a comment last week. I'm looking at dollar CAD, and this has come in from, I've lost the name, Mike Burberry 6692. Forgive me, Mike, for forgetting your name. Thank you for your comments. Westy does indeed have some competition, and please give him something nice and difficult to look at on his return from the Outback next week, just to make my day. In any case, dollar CAD is actually an interesting one. And I'm glad you've brought it up, because we had a look down towards the 134 figure last week, which is also where the 100-day moving average comes in. And that came obviously as Brent and WTI continued to charge higher. Both of those blends of crude actually hitting their highest levels since November of last year. We've since seen the CAD give back some of its gains. Dollar bulls are certainly not giving things up without a fight, as we see elsewhere. And we've also had a bit of a paring back of some of the hawkish BOC pricing after that hotter than expected August inflation number that I think we touched on in last week's show. That the odds on another hike have come back a little bit when you look at the OIS curve over in Canada. So you've got a couple of ways to play this, really. Personally, I'd be looking to be long here, obviously bullish on the dollar. I think we could get back up towards the August highs, which come in around the 137 figure. For those who like these sort of things, you've got a golden cross forming as well, with the 50-day moving average starting to come up above its 200-day counterpart, and just below that 135 figure, which is absolutely key for the pair at the moment. 134.60 is where that 200-day moving average comes in, and that could be a nice place to put a stop if you are long. On the other side of that, if we can get a closing break below those moving averages, the 50 and the 200-day, then you'd be looking to flip short if I were trading this. Probably initially looking to the prior low, which comes in at 133.80. That was the low that we saw last week. And then maybe even back down towards the 133 handle if this has legs. So you can play this both ways. There's interesting levels on either side, but personally, I think the balance of risk favors the upside here. I don't know about you, Blake.
I actually favor the upside as well. This is the one thing that I have to throw out there. If you've taken a look at crude oil's bull flag pattern does complete at 96. I'm pretty sure we've discussed crude oil several times over the course of the last couple of months, or a few weeks actually. And so my 2 cents about the dollar CAD is it would be as a large crude oil exporter. If crude oil wasn't trading in the 90s, dollar CAD would probably be closer to 138, 140, towards those range highs. And so what I'd be looking for is if you see crude oil continue to rally and it gets towards the $9,500 level and it looks a little toppy, then you might start looking for the dollar CAD to round out some sort of bottom and play it back to the upside. Because I think the dollar, there's more to the dollar story than we see here. I still think that the dollar is going to be the least dirty shirt in the dirty hamper of all of these currencies, and the dollar should outperform. So with that being said, I favor the upside as well. I think key resistance is going to be around that 137 level that will open us up towards 139, 140 moving forward. So anyway, Michael, a lot of great setups here. Hopefully you guys and gals are enjoying them. Make sure you give us a thumbs up if you are, but don't leave yet, because we're going to give you our plays of the day. Well, Michael, my first play, we couldn't get away with not showing you the S&P. So my first play of the day, or my play of the day, is going to be the S&P 500, or what we like to call the SPOOs. And so I wanted to ask, is this enough or not even close? If you look at the downside, this was our setup last week. We broke lower. We're testing the ascending trend line. We're at 127% extension, and you'll notice in black we have an AB equals CD, or an equal leg move that completed today. And once we completed that equal leg move, we had about a 25 point bounce in the S&P since then. And you know, the candle is a little bit of a, I would say, a long lower shadow doji, and that means that if we get a bullish candle tomorrow, we're going to have a good morning cross, and you're going to start to see you know, some bullish upside moves as we head into the end of the week. So the question is, do you trade it back to the long side, or wait for a short, maybe above 4,300? Or do you think it breaks down and we see the 200-day moving average next? That's the real question here. I think we've reached a lot of technical levels. The market's pretty bearish. So I'd be looking for a rally back to 4,300 to sell into. And that's going to be my play of the day.
Very good. I must admit, Blake, when I saw this picture of your chart earlier, I thought, what on earth has he done here? But you've explained that very well, and we got a little lesson on the alphabet, and I'm now off to read about Japanese candlestick patterns before I go to bed. So I appreciate it, mate.
Fantastic.
Right. I want to look at the euro this week, the horrible thing that it is. Euro dollar cracked below the 105 handle today, Wednesday, for the first time since January. And, well, you can see on this chart the huge level that it's been for the pair since the start of 2022, which is when this chart goes back to. But actually, if you want to bring up a chart yourself, since the inception of the euro, 105 has just been this huge level for the common currency, both in terms of support and resistance and defining more longer run trends. So I think we might chop around here for a little while, but overall, I think there's not particularly much going for the euro. The ECB are at terminal. Growth is deteriorating rapidly. And of course, on the other side of the equation, both sides of that dollar smile, US outperformance, that cleanest dirty shirt idea that you mentioned earlier, as well as the haven demand that we're seeing for the greenback, both continuing to work in the dollar's favor. So I'm looking to stay short euro dollar. As I said, I'm prepared for this to chop around a little bit, consolidate, maybe move back up towards 106.5. But over the next kind of 4 to 6 weeks, I'm looking for us to get nicely below 105. 103.5 is where I'd be initially looking to take a chunk of profit off. But actually, I wouldn't rule out a further loss, maybe even back down towards parity in due course, such is the rather grim fate that seems to be facing the Eurozone and the common currency at the moment.
Well, Michael, I'm so glad you brought up the euro, and you said it crapped below 105, and I have to say, here in the United States, we say it crapped the bed. So just make it simple. Well, Michael, I want to say it has been an absolute pleasure for the last, well, now 2 weeks being with you here on the trade-off. I know it's very difficult for you to get up or stay up at these hours to do the show for us. So I want to make sure that everybody back home gives Michael a big thumbs up. Tell him down in the comments below what you thought of his performance, and tell him how much we're going to miss him even when Westy does come back. But you can always catch him on the UK trade-off show, so make sure you do so as well. I want to thank everybody for sticking with us, and if you've made it this far, make sure you do, you know, like our videos, subscribe to the channel, get down in those comments, let us know those charts you want to see, you know, us look at, whether it's a setup or a play of the day. And Michael, I have to say thank you so much for being here with us.
No, thank you, mate. It's been good fun over the last couple of weeks. It's always good when we get to work together, and nice to keep Westy's seat warm for him. I'm sure you'll have fun when he's back next week, and yeah, look forward to working with you again very, very soon indeed, mate.
All right. Well, thank you everybody for tuning in this week on this week's The Trade-Off. We'll see you next week. See you then.
Bye for now.